Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and in this video I'm going to be talking about the power of dividend investing and how it can help you build your wealth over time, and how I'm using it to build my wealth. And I'm just going to show some projections of some potential gains you can make in the stock market using dividend investing. So I hope you enjoy the video, and make sure to like and subscribe to support the channel, and let's get right into it. Okay, so I basically just made this spreadsheet here, which I'm going to be using to model dividend investing. So basically, we're going to enter some key inputs right here on the right here, and then basically these are just rows over here with a bunch of information and going down each quarter. So I'm basically going to set it up that you contribute money to your account every quarter, at least you have the option to, and you get paid your dividends quarterly. And the stock price, we're going to input how much that stock price is going to appreciate on a quarterly basis as well to help track that. So let's just get right into it. We'll start just with my portfolio, for example. So as we saw the other day, I just released a portfolio update video. So if you have not seen that, make sure to go check that out up here. I'll leave a link. And right now we're just looking at the dividend yield, which is around 3.16%, and the CAGR of the dividend, which is around 6.32% at this point, and the portfolio value, which is about $1,050. So we'll use those numbers to start out our spreadsheet here. So our starting investment is $1,050, as we said, and my quarterly contribution, currently I'm investing about $10 a week, which is roughly $40 a month, which will be $120 a quarter. So that's about what that would be a quarter. It might be a little bit more or a little bit less depending on how long each month is, but we'll just say that for sake of simplicity. And then quarterly growth, my portfolio, I don't think it grows a ton, but I'll put 1% for quarterly growth, and then you see here my annual growth would be 4%. So basically the stock price, I'm saying, is going to appreciate 4% every year. And then the starting dividend yield for my portfolio was 3.16%, and the dividend CAGR was 6.32%, I believe. Let's go check that. Yes, 6.32%. And this one is really 3.61%. It's just doesn't have those decimals there. All right, so basically what we're looking at here is basically at the end of quarter one, I'm saying that the annual dividend that the company is going to pay is that amount, which is basically just calculated based on the yield and the stock price. And then the stock price is going to appreciate 1% every quarter. So now it's $101. I forgot to mention that as well. I'm just saying the stock price is initially $100 when we buy it. Okay. And then I'm just calculating the dividends I received that quarter, and then looking at how many shares I can buy based on how much I'm contributing that quarter plus the dividends I'm receiving. So I'm dripping those dividends, reinvesting those dividends back into the portfolio. And then basically this is total number of shares of that stock. I guess I'm just using this, I guess, as a singular stock or as just a share of my portfolio. I guess it's kind of arbitrary. It doesn't exactly make sense, but it works in this instance for the calculations. And then this is the market value of the portfolio just based on the shares and the stock price, and then I just put in how much I've contributed, what my gains are, and what the current dividend yield of my portfolio is, or that stock. So over here we can see after a certain amount of years, so after 5 years, my portfolio will be around $4,400, and around almost 1,000 of that will be gains in the form of capital gains or dividends. And you'll see my portfolios will at that point will be yielding 3.31%. So you guys can look through these numbers yourself. After 10 years, we'll be yielding 3.68% at a value of $9,000. After 20 years, we'll be at $28,000. After 30 years, $78,000. 40 years, $231,000, and 50 years, $773,000. And the one thing that's sort of a bit unrealistic with this is the dividend CAGR compared to the quarterly growth of the stock or the company, because basically what I did here is I put the dividend yield on the right here, because basically this is saying after 50 years my portfolio will be at $773,000, but the portfolio, which means either the singular company in my portfolio or all the companies together in my portfolio, will be yielding 8.7%, which really isn't realistic for that to be happening. So basically the way this is happening is that because the share price is appreciating less than the dividend, then the dividend is able to buy more and more shares each time, because the dividend itself is increasing as the annual dividend and the dividend the number of shares I have is increasing. So that's sort of the one unrealistic part here. So if we bump this up to, let's say, 1.5% per quarter growth, we can see that the annual growth rate is right around 6%. And so that's basically saying that the dividend yield is basically going to stay fairly constant over these whole 50 years, which in that case is fairly predictable, or at least like plausible, I would say, I guess. So in that case, the portfolio would only be at around 600,000, but even in that case, that's fantastic. So it's basically saying that the portfolio is yielding 3% on dividends basically the entire time, and then it's growing at a rate of 6% as well, which is fantastic. So that's one of the nuances, is that the higher the dividend CAGR is relative to the growth of the appreciation of the share price, then that's going to, over time, that dividend yield is going to start creeping up, and eventually that's going to become not plausible for that to continue for that far into the future. So that's just one thing to keep in mind when you're doing these kind of calculations like this. So I'm also going to input some numbers for some other companies, some individual companies, and I'll use my same starting investment and quarterly contribution, but I'll just change those other values. So I'm going to use Microsoft, and we can see here their 10-year dividend growth rate is 13%, which is pretty impressive, but I'm going to use just the lowest amount, which is the 3-year rate of 8.74%, and then I'll use this 10.45% because that's kind of in the middle, I guess. So I'll use both of those and see what happens. And Microsoft, it grows, seems to me that the share price grows a fair bit. So if we look over 10 years, the share price is up 700%. So that's a lot, but just for the sake of our estimation, I think I'm going to put the quarterly growth at around 3% for the share price, which means that annually it would grow 12% a year, which maybe that's a lot. Maybe I should put it down to like 2.5%. But Microsoft has been doing very well. So, I mean, it's hard to, it's hard to think about this being an investment for 50 years and having a realistic value. So again, we're going to look at the dividends. So that 5-year growth rate was 10.45%, and the yield is currently 1.04%. So the yield is 1.04%, and the CAGR was 10.45%. Okay, so in this case, our investment would have grown to over $1.2 million with Microsoft. And basically the yield started at 1.04%, and basically it decreased a little bit over the course of those years, because the CAGR is the dividend CAGR is a little bit greater than the growth of the company annually, but since it's compounded quarterly, that basically changes that a little bit, I think. So overall, the dividend yield is staying pretty constant, which is allowing, I feel like the maximum possibility or plausibility of an investment is around the point where the dividend yield is going to stay pretty constant. So if we lower this dividend CAGR to around 8.37%, which is I think what it was, in that case, basically the market value after 50 years would be around $1 million. But in this case, you can see over here the dividend yield is decreasing as time goes on, because this annual growth of the share price is appreciating a lot more quickly than the dividend is. So that's just another scenario. But Microsoft, it's just a fast grower, and it has been, and so maybe it's unrealistic that it continues growing at this rate. So we're going to look at a more stable company, Johnson & Johnson. And for their dividends, their current 5-year growth rate is 6.32%, and their yield is 2.69%. So I'll put those numbers in. So their yield is 2.69%, and their growth rate was 6.32%. That's exactly the same as my portfolio, actually, I think. And then we'll say that the quarterly growth is, I guess we'll say 1% again, because that's, I think that's pretty plausible and that's pretty conservative, I guess. So at that point, we would be around $550,000. But again, that yield is creeping up there a lot. So maybe if we say the quarterly growth is 1.25%, then our portfolio would be a little bit lower, a little bit under 500,000, but that yield would be a lot more reasonable, I guess. So that's the one thing that is kind of difficult when using a kind of simulation, I guess, like this, is that when you go out so far in the future, depending on the different growth rates, some of your numbers can get kind of crazy and they can seem unrealistic. So it's one thing to keep in mind. And I think if we try to match that annual growth to the dividend growth, maybe we'll go at 1.45%, maybe 1.5%, 1.55. So if we go at 1.55, the annual growth of the share price is right about the same as the dividend. So in that case, our portfolio would be around $500,000 and our dividend yield would be about 2.5%. So it would have decreased a little bit actually from the starting yield. So that seems really realistic, but at the same time, that's counting on the fact that the share price is going to appreciate 6%. So overall, like I said, some of these numbers may not be the most accurate or the most plausible, but it's just a way to try to look at the power of dividend investing. And this really shows the power of dividend investing because that's just not possible, I don't think, with growth stocks. I mean, growth stocks, you can get a lot of share price growth, but the power of dividend investing is that you're growing the number of shares. So unless the share price is decreasing a ton all the time, then you're going to be able to grow your market value of your portfolio no matter what really happens. Even if the share price kind of stays steady and doesn't grow that much, you're really going to be able to grow your portfolio over time as long as the company is still growing and the dividend is still growing. That's really going to be advantageous for you. So as you guys can probably tell, I'm a big fan of dividend investing, and I think I always will be. I definitely think there's a place in everyone's portfolio for growth investing as well, but on the whole, I think that dividend investing will always be my bread and butter, my core holdings, and I would love to start a growth portfolio sometime soon, but it's definitely not going to be a large portion of my portfolio. And as Albert Einstein said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. And I included this quote in a previous video, but I actually left off that second half, and I think that's even more important, or just as important as the first half, because if you don't understand what you're doing here, you can definitely get in a lot of trouble. So it's definitely good to do your research and really understand what you're doing before you start. I definitely didn't do enough research before I started investing, and that kind of set me back both time and money for the first few months. So definitely do your research and just learn as much as you can about investing, because it's a great tool for everyone, no matter if you're a dividend investor or a growth investor. If you do your research and if you know what you're doing, you're going to do great. So just do that, and I hope you guys have a great day, and I'll see you in the next one.